Preface. It has now been over 45 years since the first edition of A Random Walk Down Wall Street. The message of the original edition was a very simple one. Investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively managed mutual funds. I boldly stated that buying and holding all the stocks in a broad stock market average was likely to outperform professionally managed funds whose high expense charges and large trading costs detract substantially from investment returns. Now, over 45 years later, I believe even more strongly in that original thesis, and there's more than a six-figure gain to prove it. I can make the case with great simplicity. An investor with $10,000 at the start of 1969 who invested in a Standard & Poor's 500 stock index fund would have had a portfolio worth $1,092,489 by April 2018, assuming that all dividends were reinvested. A second investor who instead purchased shares in the average actively managed fund would have seen his investment grow to $817,741. The difference is dramatic. Through April 1, 2018, the index investor was ahead by $274,748, an amount over 25% greater than the final stake of the average investor in a managed fund. Why, then, a 12th edition of this book? If the basic message hasn't changed, what has? The answer is that there have been enormous changes in the financial instruments available to the public. A book meant to provide a comprehensive investment guide for individual investors needs to be updated to cover the full range of investment products available. In addition, investors can benefit from a critical analysis of the wealth of new information provided by academic researchers and market professionals, made comprehensible in prose accessible to everyone with an interest in investing. There have been so many bewildering claims about the stock market that it's important to have a book that sets the record straight. Over the past 45 years, we have become accustomed to accepting the rapid pace of technological change in our physical environment. Innovations such as email, the internet, smartphones, personal digital assistants, smart home devices, iPads, Kindles, video conferencing, social networks, and new medical advances ranging from organ transplants and laser surgery to non-surgical methods of treating kidney stones and unclogging arteries have materially affected the way we live. Financial innovation over the same period has been equally rapid. In 1973, we did not have money market funds, ATMs, index mutual funds, ETFs, tax-exempt funds, emerging market funds, target date funds, floating rate notes, volatility derivatives, inflation protection securities, equity REITs, asset-backed securities, smart beta strategies, Roth IRAs, 529 college savings plans, zero-coupon bonds, financial and commodity futures and options, and new trading techniques such as portfolio insurance and high-frequency trading. To mention just a few of the changes that have occurred in the financial environment. Much of the new material in this book has been included to explain these financial innovations and to show how you as a consumer can benefit from them. This 12th edition also provides a clear and easily accessible description of the academic advances in investment theory and practice. Chapter 10 describes the exciting new field of behavioral finance and underscores the important lessons investors should learn from the insights of the behavioralists. Chapter 11 asks whether smart beta investment strategies are really smart and whether risk parity strategies are too risky. A new section has been added to present practical investment strategies for investors who have retired. So much new material has been added that readers who may have read an earlier edition of this book in college or business school will find this new edition rewarding reading. This edition takes a hard look at the basic thesis of earlier editions of Random Walk, that the market prices stocks so efficiently that a blindfolded chimpanzee throwing darts at the stock listings can select a portfolio that performs as well as those managed by the experts. Through the past 45 years, that thesis has held up remarkably well. More than two-thirds of professional portfolio managers have been outperformed by unmanaged broad-based index funds. Nevertheless, there are still both academics and practitioners who doubt the validity of the theory. And the stock market crash of October 1987, the internet bubble, and the financial crisis of 2008 to 2009 raised further questions concerning the vaunted efficiency of the market. This edition explains the recent controversy and re-examines the claim that it's possible to beat the market. I conclude that reports of the death of the efficient market hypothesis are vastly exaggerated. I will, however, review the evidence on a number of techniques of stock selection that are believed to tilt the odds of success in favor of the individual investor. The book remains fundamentally a readable investment guide for individual investors. As I have counseled individuals and families about financial strategy, it has become increasingly clear to me that one's capacity for risk-bearing depends importantly upon one's age and ability to earn income from non-investment sources. It is also the case that the risk involved in many investments decreases with the length of time the investment can be held. For these reasons, optimal investment strategies must be age-related. Chapter 14, entitled A Life Cycle Guide to Investing, should prove very helpful to people of all ages. This chapter alone is worth the cost of a high-priced appointment with a personal financial advisor. My debts of gratitude to those mentioned in earlier editions continue. In addition, I must mention the names of a number of people who were particularly helpful in making special contributions to the 12th edition. I am especially indebted to Michael Nolan of the Bogle Research Institute and to my assistants, Benjamin So and Andaniki. I am also grateful to Chris McIsaac, Alexandra Burton, and Andrew Schumann of the Vanguard Group for important assistance in providing data. Thanks are also due for the assistance of Daniel Campbell, Jakob Jerk, Stephen Luthold, Joyce Niesman, Kristen Perlberg, James Sarvis, Stacy Sarvis, Jeremy Schwartz, Jeremy Siegel, and Larry Swedrow. My association with W.W. Norton remains a superb collaboration, and I thank Drake McFeely and Nathaniel Dennett for their indispensable assistance in bringing this edition to publication. My wife, Nancy Weiss-Malkiel, has made by far the most important contributions to the successful completion of the past 8 editions. In addition to providing the most loving encouragement and support, she read carefully through various drafts of the manuscript and made innumerable suggestions that clarified and vastly improved the writing. She continues to be able to find errors that have eluded me and a variety of proofreaders and editors. Most important, she has brought incredible joy to my life. No one more deserves the dedication of a book than she and her second best friend, Piper Burton G. Malkiel, Princeton Univer. City, June 2018. Part 1. Stocks and their value. 1. Firm foundations and castles in the air. What is a cynic? A man who knows the price of everything and the value of nothing. Oscar Wilde, Lady Windermere's fan. In this book I will take you on a random walk down Wall Street, providing a guided tour of the complex world of finance and practical advice on investment opportunities and strategies. Many people say that the individual investor has scarcely a chance today against Wall Street's professionals. They point to professional investment strategies using complex derivative instruments and high-frequency trading. They read news reports of accounting fraud, mammoth takeovers, and the activities of well-financed hedge funds. This complexity suggests that there is no longer any room for the individual investor in today's markets. Nothing could be further from the truth. You can do as well as the experts, perhaps even better. It was the steady investors who kept their heads when the stock market tanked in March 2009, and then saw the value of their holdings eventually recover and continue to produce attractive returns. And many of the pros lost their shirts in 2008 buying derivative securities they failed to understand, as well as during the early 2000s when they overloaded their portfolios with overpriced tech stocks. This book is a succinct guide for the individual investor. It covers everything from insurance to income taxes. It tells you how to buy life insurance and how to avoid getting ripped off by banks and brokers. It will even tell you what to do about gold and diamonds. But primarily it is a book about common stocks, an investment medium that not only provided generous long-run returns in the past but also appears to represent good possibilities for the years ahead. The Life Cycle Investment Guide described in Part 4 gives individuals of all age groups specific portfolio recommendations for meeting their financial goals, including advice on how to invest in retirement. What is a random walk? A random walk is one in